Hello and welcome to Personable, a podcast focused on speaking to the world's best, enabling you to become the best you can be. Whether you're a first-time listener or a returning listener, please make sure to like, subscribe, and leave a comment. At the moment, only 3 out of 100 of the subscribers of Personable are actually subscribed, and we're trying to get to 1,000 subscribers before I get back to Duke in the fall. Today, I'm going to be joined by Ted Tobiason. Ted is the CFO for Vimo. He's a former CFO of Lime, a former managing director at Morgan Stanley, the former head of technology, ECM at Deutsche Bank, head of technology at Bank of America, and a graduate from both Princeton and an MBA at Columbia Business School. I'm incredibly excited and honored to speak to Ted today. Ted, I want to get started by asking you, how did you break in and what made you interested in going into investment banking in the first place?
Yeah, so I had an unconventional entry into investment banking. So I started out of college doing things sort of supply chain manufacturing. I had spent time over in China helping to set up an electronics assembly shop. This was in the very early 90s, so before that really took off. And then I had spent some time in Russia working in a turnaround of their largest truck and car manufacturer. So I ended up at Columbia Business School, which has got a very close connection to Wall Street. But I intended to go back into the manufacturing or the technology side of things. My brother was at Venture Law Group, and he had out in Menlo Park, and so he was working with a lot of technology companies, and I had bought semiconductors and done some software stuff. So I was planning to go out to Silicon Valley really and do that. But I met a girl, and she was working at the Federal Reserve, and she was in New York. And so all of a sudden, my plans changed where I needed to stay in New York. And at the time, there wasn't really a technology industry in New York. There's obviously no factories or anything like that was related to my experience. So I pivoted because I needed to stay in New York. And career options in New York, you got Broadway, and I can't sing and dance, and you got Wall Street. So that's when I all of a sudden was like, I need to get a job where I'm in banking or something like that, so I could stay in New York. And so I guess 30 plus years later, 2 kids and an enduring marriage and stuff, I think that was a good decision. And I loved investment banking. It was great, but the reason I went in, like I said, it was very, very unconventional.
As a student at Duke, and I feel like many of the Ivy Leagues, Stanford, Ivy Plus as they call them, it's sort of like investment banking, consulting, be a doctor, a lawyer, go into tech, those sort of things, with investment banking being one of the most desirable careers in the entire planet. But over the past few years, largely due to the pandemic and IPOs starting to drop, investment banking was seen as a less attractive option because they were hiring less. There was a bit like a hiring freeze because the banks were making less money. Do you think investment banking is still as relevant in 2025 and then it will go to the heights that it once was at?
It's a great question, and my friends, I have a lot of friends who still work in investment banking, and I work with investment bankers. Like I talk to investment bankers all the time because our company may end up hiring investment bankers. The kind of the death of banking has been written many times, so I think it will endure. As far as is somebody who's in college thinking about whether to go into investment banking as a 2-year, I'm going to do something to start. I think it has a great deal to offer. I will also say, I think any job that you take out of college, you can make success. You can do very well at. Conversely, you can make any job not a success. But the skills that you learn in a 2-year program about the analytics, about simply just kind of the work ethic that comes with doing a 2-year analyst program, the intensity of it, I think all of that will apply to just about everything. There are a lot of people in Silicon Valley who are in 2-year programs and things like that. So I think AI has changed a lot of things. Investment banking has changed a lot since I started in the mid 90s about what the job looks like. When I first started, sales and trading was very, very different than it is today. And I kind of wonder if some of the automation that changed the nature of sales and trading is also going to happen to investment banking. I saw a headline, an article, and kind of read a bit about it. The CEO of Goldman Sachs said something about the percentage of a S1 filing for an IPO that can be done in just minutes by AI. And the read through on that is like, what does that mean for the junior level in investment banking. And of course, I also think if you have a lot fewer junior people, how are you managing the supply chain of getting senior people? Because you kind of need people to go through that program. So yeah, a lot's changing, but all this stuff is healthy. The transfer processing, manipulation of data becoming really, really cheap, and approaching zero and becoming more accurate is great for everything, and it's great for the finance industry. It's made everything much cheaper, and so I would say to somebody such as yourself or one of your colleagues who's thinking about going and doing a 2-year program, I would encourage it, and because I whether it's an enduring thing or not, what you learn in those 2 years will be very, very practical.
I want to go ask a few more questions down the investment banking route and then transition to something else. Something I've noticed having done this podcast and speaking to people that aspire to be like the guests in this podcast, if this is the top 10%, 1%, 0.1%, is that everyone sort of wants the same things. They want money, fame, success, prestige, but not everyone's willing to do that. And I feel like investment banking is a bit of a black box in that not only are the firms very secretive, a lot of the people at the firms aren't really allowed to post about their experience unless they leave the firm. I think a number of years ago at firms like Goldman Sachs, JP Morgan, Morgan Stanley, there were complaints from employees, anonymous reports to newspapers saying they were being overworked, talking about poor working conditions. What does it take to be an investment banker? What did it take to be an investment banker when you first started? And how did that change over the years towards when you were ending your career in investment banking?
So I remember in 1999, a group of analysts, the kids just out of college, they basically kind of had a revolt and they wrote an open letter. I think they were at Salomon Brothers, and it made it into the Wall Street Journal. And they wanted certain things. They wanted to not have to wear a suit to work. Now, analysts are really kind of back office. They're not pitching clients and things like that. So that one was pretty easy. And today, you don't see analysts or junior people wearing suits at work, at least not that I'm aware of. And, there's things about the number of hours they work and access to vacation and stuff like that. And then, of course, the tech bubble burst and, all of a sudden the analysts were saying, I just want to have a job. I don't care, how much I have to work. And so these things kind of wax and wane based on where we are in the economic cycle and the financing cycle. I do think, as a manager of junior people and having been a junior people long ago, that if you are routinely having your junior staff pull all-nighters, that's poor management, because I think the quality of work after 11 p.m., 1 a.m., or whatever else starts to get pretty poor, and you get rework. And I know this from my time in working in factories and stuff. You want to avoid rework because rework is not just expensive, but it's a lot harder to go through a flawed financial model and fix it than to just do it right the first time and take your time.
So what is rework?
Rework, meaning like you have to fix something. So I was working in a plant where we were stamping parts for a truck. And if you have steel that's not up to the right chemical composition or thickness, it'll tear. And now you have to weld it. And when you weld it, you're creating other problems, not to mention the fact that it's expensive and you have all different types of issues. Well, the same thing is true in investment banking. So you have a pitch on Monday, let's say. It's an IPO pitch. And you give your your staff a bunch of things to do about coming up with the valuation of the company, to whom you would sell it, how you would sell it, and all the standard stuff in an IPO pitch. And it's Sunday night. And the MD goes to review the model for the valuation and goes bonkers. Something's wrong. There's a flaw. It's 11 p.m. on Sunday night. The pitch is at 9 a.m. on Monday. Well, there's a lot of problems with that process, because if you're just figuring that out on Sunday night, and by the way, this happens a lot. I'm not talking about a corner case. This happens a lot. And this is why I think a really good manager is checking in on the workflow through the process and intercepting these flaws early on, so you're not trying to correct something late at night or early in the morning right before a pitch. But I can't tell you how many times I've seen pitch books go through major revisions, and where you're wondering, like, is something as simple as, with all the books printed, did we grab the right ones? And that type of rework leads to I'd say the banker's not giving their best work for the client to not get their best work. And when you really should be thinking about is what you're going to say in the meeting and how you're going to respond to questions and things like that, rather than, figuring out flaws in a financial model. So what you have there is the analysts are miserable because they've been in the office all weekend. They probably got yelled at 11 p.m. on a Sunday night, and then they had to stay all night trying to fix something, and you end up with a product that's not as good as it should be. So the best managers that I've seen in investment banking, their employees are not pulling all-nighters very often. They do a good job of managing the energy of their employees. Think about it like NBA playoffs are right now. And it's in the fourth quarter, it's a close game. A really good coach has not exhausted his best players to the point where they're barely hitting the front of the rim when they're shooting free throws. I was watching the game last night and this kind of happened. And it's hard to do, where you kind of have to manage the energy and the focus, because human beings cannot run at a full sprint beyond exhaustion without having, high failure rates and all the problems that come with it. So I think that investment banking will be better by the new rules that have come out about managing analyst time so they can't pull all-nighters and they get at least one day off a week and things like that. They'll also retain people because you'll have less burnout. And, retaining your best people is hard because there's always like a high bid for talent, whether it's, the hedge funds, the PE firms, other banks, and so forth. So I think these things are good. But I would say for somebody, if they're talking to me about like, what do you want to get out of your first few years out of college, and somebody starts talking a lot about quality of life, it's probably not going to be the best job for them, because it is intense. You are going to be spending weekends. You are going to be getting home, late. And if you're somebody who says like, I'm just not happy if I can't get to the gym 5 days a week and I can't have my weekends free, it's probably not the job for you. That's okay.
Having spent most of your career with a focus, both investment banking and post-investment banking, building up your knowledge in the tech industry, what has been the key differentiators between working in investment banking and learning about tech to actually being in tech companies? And did those skills transfer across from investment banking, learning about it in theory, versus actually being in it in actuality?
Yeah, another good question. So I work for a software company, and I've written some rudimentary software, back in the 90s. I am not somebody who writes software. And I think very much that, like on our executive leadership team, we have software engineers in abundance. We have people who look at things in terms of technology and applying R&D to solve issues around gross margin, which is my finance brain, how I look at things. And I try to approach it as somebody with a background in finance, with a background in how investors, whether they're public or private, would look at things, and how people who might lend us money would look at things, and a perspective around managing risk and so forth. I think it's important. I think it's a really good thing for CFOs, and I've watched a lot of CFO-CEO relationships over the decades, almost 40 years now, and I think that there are a lot of ways to do it. A lot of really good CFOs who do it very differently than I, for sure. But I think one of the good things is where you have a finance, economic, sort of FP&A, which is financial planning and analysis oriented CFO, who acts kind of as a governor, is like, well, we need to measure, we need to know what the right performance indicators are around these types of things, and how we're going to look at whether it's how many engineers we need to have for a given amount of revenue and things like this. I think that's important. So I don't really consider, even though I've been in technology companies now for quite some time as opposed to banking, I don't think of myself, I still very much think of myself as a finance guy as opposed to a technology guy. And I try to approach like our board meetings and our executive leadership team meetings with that mindset. And so it translates very well. So I spent decades on IPO roadshows listening to how the smartest, best technology investors asked questions to management teams, and I learned a lot. Like, how do they evaluate this? How do these people find value? What's creating and destroying value, and so forth in there, and how are they evaluating risk? And I try to apply that in the business sense. And there are pure technology people who will say that, well, you don't want to have an accountant or an investment banker or the MBA guy running a technology company because you need to have it run by founders, engineers. And I buy into all that. There's a great deal of truth to all of those things. And if you look at the great tech companies, they tend to have those characteristics. So I think that it has to be, I know what I do. I'm the partner to the CEO and I report to the CEO and I try to help and provide guidance on these types of things. And of course, if we're going to do something that relates to capital raising, that's right in my wheelhouse.
A lot of your focus is, as you said, on planning ahead in terms of, having a business mind on the business rather than just simply, saying what happened. You're actually having an engagement with the CEO and with the business. Over the past couple of months, as I'm sure you've noticed and the rest of the world have noticed, Donald Trump has got back into power. And one of the big things that he's introduced has been tariffs. As well as that, over the past 20 to 30 years, China went from a country that was doing all right to probably the second biggest superpower in the world, particularly within manufacturing, becoming highly skilled with some of the best and most powerful and most cost-effective factories on the planet. From your opinion, how have the tariffs impacted your business? Do you think they're a good thing, a bad thing? And what do you think, do you think they should be continually used as a negotiating tool, or do you think it creates too much uncertainty?
That is a $1 trillion question right now. So I'm a big believer in Ricardian economic theory, which is about comparative advantage, where things should be made and things should be done in the places that will do them the best, and that you end up with kind of a Pareto optimal outcome if you do these things. And it's like in my company, you don't want me designing the software, and you don't want the software engineer doing the FP&A. We kind of go where our comparative strengths are, and you end up with the best possible outcomes. I'm a big believer in that. And in my very first job out of college, working for this guy who I thought was brilliant, Tim Gollin, I was at Gollin & Company, employee number 7, and we were trying to figure out where things should be made for specific products. And so if you have something that's got high labor content, low technology, it's pretty hard to make that in America and make it economically. And then we put up an electronics assembly factory in China, and I think we got a little bit over our skis in terms of what the workforce there was capable of doing. It's not just the cost of labor, it's the productivity labor and the sophistication of the labor, which in 1992 was not high. Today, obviously, it's truly extraordinary in China. So the short answer is, I think that the tariffs I think it's added a great deal of uncertainty into the economy. And I used to be at Lime, and one of the things that reported into finance, so reported into me, was logistics and purchasing of scooters. And so, how do you figure out, if we wanted to go, if I'm at Lime, which was just some years ago, but if we wanted to enter into a city with 2,000 scooters, we're trying to figure out the economics of that. Will that work? Well, if you don't know what the cost of a scooter is going to be because of impending tariffs, how do you figure out where you should go? How do you figure out how much the price of a scooter should be today if the replacement cost could be 2x the value of the scooter that you got now? And so it's paralyzing for a lot of things. And so I'm not a big fan of the tariffs. I'm very much a free trader on these things. And I think, the idea, the whole concept of a trade deficit, I don't know what that is. I have a trade deficit with Whole Foods, and I think that's okay. I get food, they get my cash, and that's okay. I have a trade deficit with just about everything except my employer who has a trade deficit with me. So I believe in the idea with free exchange makes both sides wealthier. If we didn't want the product from China or from wherever it may be, we don't have to buy it. Both sides are made better because we would prefer to have the product than the cash that it costs. So it's kind of the Adam Smith invisible hand way of approaching it. So, I don't think that we're likely to achieve the goals that the tariff people, that Mr. Trump expects to get out of this. I don't think we'll see a big step function change in manufacturing in the United States. I think we'll probably just get kind of higher prices. I also think there's something really stabilizing about trade where, somebody has a couple $1 trillion worth of business every year with us, makes them less likely to do things that are antithetical to our economic health, if you know what I mean.
Over the past few years, there's been a tremendous, almost exponential level of growth throughout the world with the introduction of technology, medicines, and pretty much every area of our life. And in the only 20 years that I've been alive, I've seen a huge number of introductions from, the iPhone, AI, etc. The list goes on. However, something I've noticed is what's kind of false and what's just kind of like, a pocket of air versus what's actually reality. I mean, actually, a few years before I died was the before I was born, was the dot-com bubble. And then obviously there was the 2008 financial crisis with mortgages. But then over the past few years, as I became more interested in investing, I kind of saw this backwards thing where people, when they, the price is high, they buy, and when it's low, they sell. But on top of that, there's been these huge trends, and the current one is AI. A few years ago in 2021, cryptocurrency companies were reaching sky-high valuations. NFTs were going to be the next biggest thing. The metaverse was going to be the next biggest thing, with Facebook changing their name to Meta. Whereas AI is, since last year and this year with ChatGPT and, Bard and all the other ones, it's still sort of the talk of the town, and they're still getting sky-high valuations. If you look at the list of companies that Y Combinator want to invest in, they're pretty much all AI companies. Do you think AI is a pocket of air? Is it noise? Or is it real? And do you think we're over or underestimating just how big AI is and the efficiencies that it will bring for the human race?
So, all right, I will say, to start this off from the very, very top, I think 1,000 years from now, people are going to study this time period, starting with the invention of the transistor all the way up to today and hopefully for the next 100 years. But I think they're going to study it kind of the way, we look at, the Bronze Age, the Iron Age, the Enlightenment, the Renaissance, the invention of the steam engine. It's just this, like what we have now, you talked about all the innovation, whether it's in medicine, biotech, technology, the way you make standards of living better is by being able to increase the amount of output for a given amount of labor, materials, and capital. And we're doing that rapidly. And if in my lifetime, your lifetime, we've seen standard of living increase by a lot. And, kind of a great thing to do is to go get a car from 2000, about when you were born, and drive it. And you're going to say, this car stinks. It's, I don't know, I can't recall if we even had Bluetooth back then, but cars today with all the sensors they have, and, I remember when the first airbag came out, and, airbags were a luxury item. Now you have side airbags, airbags everywhere, and the airbags are better because the sensors are better, and you have anti-lock brakes, and you have crash detection and automatic braking, and we're on the dawn of, you've ridden in a Waymo. Like I have a Tesla, and I use the autopilot, and it's just phenomenal. These things are incredible. Like this is a glorious age to be alive with all the innovation that's happening. I think these things are exceptionally real. And I remember when the tech bubble burst, and, a lot of folks saying, wow, the internet was a fad and stuff like that. And, there was enormous destruction of capital when that bubble burst, and most of those companies went out of business. And I remember when Amazon was like, I don't know, is Amazon going to continue? Is it going to work? Is it going to happen? But the internet is certainly very real, and it's made, it's come with some costs and some things, but it's made the transfer of information, the availability of things exceptionally cheap, and, standards of living have been increased by that. I think AI is going to do the same. I'm 56, so I learn things. It's hard for me to learn new things. I'm at that age, the old dog. I use AI every day. I use it for a lot of things, and it's truly remarkable. And in my business, we use AI extensively, and it's the classic, we're able to do more with less. Which AI companies are going to prevail and be great investments? That's like, man, way over my head in figuring that out. But will it create a great deal of value? Absolutely, for sure. I think it's very, very, very real. And I think the use cases on it, we're just scratching the surface.
There's that saying, is it that one boat that rises, or is it the tide that rises and brings up all the boats? And that's sort of what's being seen with the AI trend. Playing sort of devil's advocate, I do side with you to think that, AI is going to be the next big thing and is going to offer a lot of value. It's hard to tell which of these companies are actually going to drive the value and which won't, but in a sort of perfectly competitive environment, that will sort of break free. Well, is it really a perfectly competitive environment because the costs are so high, but they're coming down? That's something to work out. But something that still sort of perplexes me is the idea that when the metaverse was announced, or when NFTs were announced, or cryptocurrencies not doing well, and now Bitcoin's the most popular thing again, how can you tell when something is actually real and tangible? Even from a company standpoint, it used to be, is this company generating revenue? Are they generating profit? And then you saw Uber come through and it had no profit and it was reaching billions in valuation. So how, as an investor, as someone that's not in the finance or VC space, that's just trying to make sense of it all, when these big waves happen, and maybe it's AI for the rest of my lifetime, I don't think it will be. I think there'll be different trends and waves coming forward.
Yeah.
How can I go about telling what is real and what is fluff?
Well, I mean, that's why the investors who do a good job of that fly private planes. It's hard to do. It's and I was at a hedge fund for a short period of time, and I kind of, at one stage of my career, I looked into getting into venture, and I thought, what these venture guys do is black magic to me, where they don't look at, there are no financials. A lot of these companies are pre-revenue, and some of them are pre-customer and stuff, and how they figure out what's going to happen. Of course, they have highly asymmetric outcomes, so high failure rates, but the ones that succeed are truly, truly extraordinary. But I think the folks who are able to discern that type of stuff, like, they think in a way that's like way over my head. It's like playing a 2200 rated chess player. It's like, I'm not in that league. But some things, now as you move down the chain of maturity, so now you get a company that's got revenue and it's got some financials. One of the things that I spend my time looking at is around unit economics. So with Uber, for example, Uber lost money a lot, and they were a client of mine at one time, and I helped raise money for them, and I thought it was a truly extraordinary company, and in fact I invested in it. So I put my money where my mouth is on that, and it's like, well, why would you invest in a company that's losing money so fast? And that is because it seemed that the margin structure that they would be able to get to, and so here's the path that I took on it. Is like the expected margin that I thought they could get times the size of the market times their market share yields a number, and that's basically free cash flow. So basically what I've done is kind of like a DCF. And everyone likes to mock DCFs, but even like when people talk about revenue multiples, so why is something worth 10 times revenue and another company's worth 5 times revenue? Well, what's the difference? Well, it's the expectation of what the cash flow generation will be at some point in the future and the probability of them achieving it. And Uber had a very, very aggressive market share strategy, which is the idea, you got to be the first with the most, because in the world of technology, the company that has the largest market share has traditionally got the bulk of the profits. And I think that's been the case with Uber. So now they are a pretty profitable company, and they did get there. But it's a hard strategy to do, to make work. And they did have to raise an enormous amount of capital and take a fair amount of risk to get there. I think it's going to be really interesting to see over the next 10 years or so what happens with Robotaxi and Waymo and stuff like that, and how that plays into what's going to happen with basically the cost of drivers. Because if you can replace the labor of a driver, what does that do to the business, and who's going to win in that? And I don't know. I'm not selling my Uber stock, so it's just something I think a lot about.
Prior to your time at Vimo, you were CFO at Lime. When working at Lime, actually taking a step back, over the past semester I was in a class at Duke focused on businesses and organizations. My professor, actually someone I'm going to interview soon as well, used to be the CEO of the Tiger Woods Foundation. He's been in companies for over 30 years. And one of the core exercises we did in this class was focusing on values. So what's the core behind what the company's trying to achieve? So like for Goldman Sachs, it's one of the 4 core values is excellence. For Starbucks, it's kindness, and all these different companies have different sets of values. When you're in a company like Lime, is the core focus for you as the CFO, internally, externally for the company, should it be on profit or on moral progress and a higher purpose?
So, going back a few years, like the idea of Lime that you could take, instead of having, 2,000 pounds of steel and everything else to transport a single person a small distance, it's just more efficient economically, environmentally, and everything else to put them on a scooter. And then you kind of have sort of the joy. Riding scooters are fun. And from a tourist standpoint, I think one of my best experiences ever as a tourist was riding around Paris on a scooter. Absolutely phenomenal. Lots of fun. So that was sort of kind of the grand thesis of, kind of being fun, being efficient, the environmental aspect to it. What I tried to do there is think about kind of KPIs and rigor around the economics of things, how we price the product, where we choose to deploy scooters, how much we pay for scooters and things like this, and some economic rigor to this idea. And it's hard because like putting scooters into city A versus city B, it's kind of hard to know which one's going to work until you kind of have to do it. So you got to go experiment. But when you experiment, you need to have a hypothesis and you need to know what you're measuring so you can figure out what success and failure is. Like one of my favorite things at Lyman, we had a great time there, but was looking at the daily reports and just seeing Calgary, of all places, just having stunning economic performance, just stunning. And so, call up the guy who ran the Calgary office, say, what's going on there? What's it about? And, it's there in their summers, you got really, really long days and you got some pretty good distances. So the scooter rides were long, and how would you know that Calgary was going to be so good until you go and you do it? And the scooters, they're Canadians, they're nice, they're polite, they didn't throw them in rivers. So yeah, it was great. So all these things, you just kind of have to figure it out. And I haven't been close to the scooter business in a while. I hear they're doing quite well, but I don't know that from firsthand experience. But like some of the European cities were just phenomenal and really fun to cruise around on a scooter. But what I tried to do, the angle I had there, and I think the reason they hired me and wanted me at the time was because that model required a lot of capital. And I was an investment banker. So, I raised money for companies. And so I'd say the capital markets part, I tried to apply my time really around the analytics, but I think that the reason they hired me was for the capital raising side of things.
We've touched on it multiple times, both in terms of your transition from investment banker, your focus in the tech space, being in investment banking to tech, and having now left Lime to work at Vimo. For those that don't know what it is, could you describe what is Vimo, why did you join it, and what do they do?
So what we do is our primary product is we run Obamacare ACA exchanges for states. That's our biggest product. And so the state is our client. And you have individuals who go on the exchange, and you need to determine what their eligibility is, what subsidies you might apply. So as I think about kind of one of our core strengths is thinking about eligibility, using public information and what people provide to us to determine eligibility and then apply rules to it. And then you have the insurers that are on the exchange too. So we run these exchanges. And we're a cloud-based company, so it's write once and then print many times. The solutions that we compete with are usually custom-built solutions, so they're expensive, they're kind of rigid, hard to modify, and if everything is bespoke, you have kind of a high cost of implementation. So I think a cloud, and you see this in the private markets, cloud-based solutions just tend to be better, cheaper, easier to operate. And again, that write once, print infinitely in the world of software is why software companies are so great and command such great valuations. We have a more finite market, so which is why I say, write once, print many times, and the economics that come with that. And of course, is one state asks for these types of features, we push it to everybody. So the more states that we get, the better our product gets, which gives us a higher barrier to entry. And for the last dozen or so RFPs, we've won all of them. So that's our primary product. We have other products around Medicaid eligibility, food stamps. We have a child care exchange, which is, again, same type of thing, is that you have people who need to get child care. The states want to be able to have women in the workforce. They want kids to have access to child care. But so the exchange is, again, around kind of eligibility, determining who is what and eligible for what. And and by circumstance adding subsidies to this. So those are the states are our clients, and so it's a good business. And why'd I do it? Because I think the things that really struck me at the time, this was 4.5 years ago, is that government had not moved to the cloud yet. And as an investment banker, there was a time when it just was sort of, you could print these deals where it was a software company that said, we're going to take a traditional software business and put it in the cloud and take market share from the incumbents. And it just keep doing it. And it's like, well, the federal government is about 20% of the economy, and then you add the states to it, and I don't know, we're probably close to 30%, somewhere in that neighborhood. That's a big part of the economy, and none of it was in the cloud. So I looked at that and I thought, there's a real opportunity here. I really like the management team a lot. Cheney, the CEO, who, by the way, went to Duke, and he should be on your podcast. He's a great guy. And he had several startups. He's, been there, done this. He's done this a few times. So when I was chatting with him, I was like, gosh, the CEO, CFO relationship, I think is really going to work here. And then I like the board of directors quite a bit. Bessemer is our biggest investor, and I've had great relationship, experiences with them over the years. And one of our board members, Mary D'Onofrio, happened to work for me many years ago when I was at Morgan Stanley. Ironically, I wrote one of her business school recommendations, and one of the questions was, would you ever work for this person? I was like, I'd be quite lucky to do so. And so Mary is the person who introduced this to me, which is another reason why you should treat your junior people well, because you want to be 100% referenceable. You never know, they may come back and find you a job.
You talk about how, as a company, for the last 12 states, they've said yes to Vimo with working with you. And as you obviously get better, there's a higher barrier to entry for potential competitors. Could you talk a little bit about what the benefits of your service or product are for the states, and by extension, what the benefits are for the voter within those states, who are voting for their politicians to want to have something like this? And as an extension of that, what are the barriers to entry? If you are offering a product or service that's, not to steal your answer, that might be cheaper or better, why wouldn't the states automatically go with your service versus doing it themselves?
I mean, you answered a bit of it. Everything kind of comes down to better, faster, cheaper, more flexible, things like that, and all that kind of good stuff. And I don't want to give you a trite answer, and I give you a real answer. So states running healthcare insurance exchanges, they can use the federal system, they can use our system, they can use somebody else who does a state-run system. The federal system has been in since inception. It's kind of expensive, it's federal, so it's kind of one size fits all. With us, our solution is less expensive, but I think that the primary thing, the reason I think that the states really like is it gives them control over what they can do. They can tune it to however they like. It's very, very, very flexible, and I think that they like that control. We quite often will run a call center attached to it to answer questions, and I think that we provide an entire service that makes the people who go on the exchange, they get things faster. So when you think about eligibility, a lot of things, whether it's Medicaid eligibility or other things, a lot of times you have a high error rate where somebody says, I'm eligible for this instead of that. And so that's kind of a failure of the system, assuming the person's right. But figuring out as fast as you can who is eligible precisely for what, and to do it instantly. And our goal is to be able to do it in nanoseconds, as opposed to some of these processes which can take days, and try to have as little going to a call center as we can. And of course, we're using AI in the call center to make that more instantaneous as well, and more efficient. So I would say it's not just the cost. The cost is certainly a component. I'd say it's the flexibility and what's required to maintain it.
Having worked there for a number of years now, I would love if you could sum up 3 things: your impact on the company so far, your leadership style, and how the company has grown in the years since you've been there.
So my impact on the company, on this one, I try to stay very, very humble, in that we have a team that goes out and does these RFPs and wins these contracts, and they're essentially our sales force. And with cloud-based software companies, generally speaking, the sales force is the largest cost item, and for us, it's not, because we don't have that many targets to go after, which is one of the reasons why the economics of our business is quite good. But the team that goes out and does and wins these RFPs, I think they're extraordinary. I think they're very, very talented people. I think that working with the states I've learned is unique than working with enterprises. They're very, very conservative, and they should be. They're dealing with people's insurance, people's healthcare. So they're very, very conservative. When they work at states, they don't have the same type of profit pressure that private companies do. So it's a different approach, and I will say that was like a unique thing for me coming in. Like I from the outside, it's like, this is pretty different. And I see these people, and they come to our conferences and stuff, and they're exceptionally well-meaning people, working hard and taking this stuff very seriously, as they should. Again, healthcare insurance for people. So I look at that team and with admiration, and I just, like, when I have my one-on-ones with them, I always like, what can I do to help? What can I make sure you're getting the resources that you need to do what you do? And then on the engineering side is, we're a product-led company, and to have the best product, I do think about things like, as I mentioned before, about the R&D expense relative to gross profit, which is something I've always found kind of fascinating. I think is a good way to measure companies and make sure that we're efficient. But we're really product-led, engineering-led, and also there is like making sure that they have the resources. I do talk about KPIs a lot, and because I think that people perform better when they know that they're being measured, but they have objective measures that everyone's kind of agreed to that, again, define the value created or destroyed by the work that's being done. And I think that's important, as opposed to just going out and working hard and doing stuff and hoping that at the end of the year, I think Henry Ford said that you got a pickle barrel and you just see how much money's in it. It's not I guess it worked for Henry Ford, but generally not the best way to go about doing things. So I think our team has really bought into doing these things. We acquired a company a few years ago, and I was pretty involved in that, from banking, looking at M&A, is like, how do you structure a deal? How do you evaluate a deal? How do you come to the right price? And doing private to private transactions, which involve stock, are really, really hard, because now you're valuing two companies. I was pretty proud of how that transaction went, and the earnouts that we had, which I thought were very fair and constructive and put incentives in the right place for the target company and were good for Vimo. And I think that acquisition has worked out quite well. When adding to us, we used to think about more shots on goals, because there are only so many states that can have ACA exchanges. How do we have more shots on goal? And I think, it's worked out quite well for us in that. So I like to think that's what my impact has been. I really enjoy my one-on-ones with the CEO. He's a very, very creative guy, and I love it's good how different we are in some things, and that he likes to say, here's 20 ideas, and I'm fine with 95% of them being bad. Let's figure out the one that's good. And I love having those conversations with him. Like him calling me up at 7 o'clock at night while he's driving home saying, I've got a crazy idea, is like one of the most fun conversations I can have. It's great. I'm like, I want to hear a crazy idea. I'm going to, sit back and have a cup of coffee or something and chew on a crazy idea over the next hour.
It's funny, I actually wrote down on my iPad, it's almost as if you read my mind, because my next topic was going to be the art of deal making, and you sort of swiftly moved into that anyway. I can recall watching a video from Warren Buffett, one of his investor meetings. He's obviously done that for a number of years. And I think he said that one of the best jobs you can have is fundraising. If you're able to sell, if you're able to get large amounts of money, you can take a percent of that. I'm not sure what the actual economics was like for you, but I can recall Warren Buffett saying it was one of the best jobs. On that point, and with your swift transition, I want to know that from your perspective, What is the art of the deal, and how do you raise lots of money? What does it take?
So I think it also depends on what stage a company's at. And, somebody who's walking around with a business plan and talking to seed stage stuff, I've not had a lot of interaction with stuff that early. And as I kind of mentioned before, I look at that as black magic. And so most of my stuff has been late stage financing, working with Airbnb was a magical experience. Brian Chesky's phenomenal, really, really fascinating guy. And, with Uber and working on the Avago IPO years ago was a truly special experience. And now that company's worth 10 times the value of Intel, which for me, growing up where Intel was the chip industry is just absolutely amazing. So the art of the deal, and I wish I had a better answer for you, because I think it really depends on the circumstances of the company, the stage of the company, how much capital it needs, and then you kind of have differences in the environment. So I worked on an IPO, and I'll leave this one nameless, and this was in maybe 1996. And this is more of a war story versus a how-to, but hopefully it'll be interesting. So you're going to get a war story out of this.
Take it.
So it was a couple 24-year-olds, and they started an internet company, and we took them out on the road, and the deal was cold. We couldn't get the deal priced. And then all of a sudden, momentum happened. And momentum investing is a pretty fascinating phenomenon when it happens. All of a sudden, the deal got, extraordinarily oversubscribed. Somewhere like 100x or something like this. And we're going back 30 years, so, write all this stuff in pencil. But just extraordinarily. So it priced at a high price and then traded up to $100 or something crazy, like $12 to $100. So it's good that I'm not naming names, since I'm getting all these facts just directionally correct as opposed to precise. And a bunch of people had put orders into this. This deal actually had pretty good significance because a bunch of people had put orders into it without putting limits on it. And so they got filled, instead of it like, the $12 IPO price, they got filled at like 96. Some people were kind of upset. So one of the rules that changed in deals after this was every IPO order was had a limit or something like that. And gosh, I've been out of capital markets for a few years now, so I probably should have come up with something else to talk about other than this. But that deal, did we sell that deal, or did that deal sell itself? That deal sold itself. That deal was just kind of a phenomenon, and a big boulder rolling down a hill, and we just had to get out of the way. And I think that company ended up not making it ultimately. But that was just momentum, and there's an awful lot of that. And I think that stuff is unpredictable rather, and generally kind of you want to avoid it. We sat in a circle, and I have a rock, and I say, "Hey, Harvey, this rock, I'm going to sell this rock to you for $1, but it's worth 10." And you give me $1, you get the rock, and you look at the guy to your right, and you're like, "Hey, this rock's worth 10. It's already doubled in value, from the last guy. I'll sell it to you for 2." And you go around the circle, and by the time you get the rock comes back to you, it's 100x. It's gone up. Don't miss out on this. If you're missing out, you got to get in on this rock thing. This rock thing's really skyrocketing. It's going to go to 1,000. It went from 1 to 100. Get in on it. At some point, people are going to figure out it's just a rock. So that's why I say you want to avoid the momentum investing of things as much as you can. So starting out with, like, if a business is a good idea, which will result in a good business, which would be kind of an early stage way to approach things. And then the later stage, like if you're at a private equity fund, you're thinking, okay, we've got a business. What can we do to make this thing truly, high cash flow? Like if it's generating 10% cash flow margins today, we buy it, lever it 5x, and then what we do is we double the cash flow because we figured out the businesses that stink and we get rid of them. We figure out the businesses that are good, we put more capital into them, we do that, and we take this asset and we just make it better. And because we levered it up 3x or 5x, we can make a great deal of money. That's like a totally different concept on how you sell a deal. And I think a really valid and good one, no less valid or good than like the early stage guy that takes a concept and goes and sells the concept about future profitability. So I don't know, it's kind of a meandering way to answer your question of saying, in a nutshell, it sort of depends on the circumstance.
But beyond a certain point, even these firms that are looking to IPO, there's a reason they hire investment bankers or ECM teams or DCM teams in the first place, because there is a possibility of stuff going really well, but also stuff going really badly. What do you think is the secret sauce? I mean, oftentimes or the edge that you can bring. I mean, oftentimes with early stage companies, it's seen as, is it the founder that makes them worth investing in, or is it the idea? But with a later stage company, what do you think is the thing that, you as an investment banker or you as within a company, when you're trying to make the deal happen, is it experience? Is it the company? Is it luck? Is it a mix of all these things? And what have you seen over time as things that have gone well versus not gone well in the art of the deal?
I'm going to take an angle on this question. And the angle I'm going to take is, if I were hiring an investment banker today to take me public or to raise me money in the private capital markets, what would I look for in that banker? And there are a few different things. One is, you're going to go through what's called roadshow prep and try to figure out how are you going to sell your story in a concise and accurate manner that also creates expectations that you can meet. Because if you just go out and just say, yeah, we're going to, rocket ship and everything else, and you don't do it, you face the consequences of those expectations. And I used to say this as part of my shtick when I was a capital markets guy, is like, be careful with the expectations you create, because that will come back. You're going to have to meet those expectations. So, you really need to be judicious about selling the upside growth story, but also the expectations that you create. So roadshow prep, very, very important about how do you tell a story in 45 minutes so that they're not going to make a decision based on that 45 minutes, but they're going to make the decision on whether they're really going to go in and do the intense amount of work and modeling necessary to come up with a view. That's what you want in that 45 minutes. Roadshow prep, I think, is really important. And having somebody, like I was a much better investment banker after I had been in the hedge fund early in my career, because I had been on the other side of the table and had to make those decisions. And one of the first things I did when I was doing roadshow prep with management teams is like, let's get everything out of your deck that's not talking about growth, profitability, and risk. Just get rid of it. Don't talk about it. Growth, profitability, just hunker down and just be dialed in growth, profitability, and risk. And I put those things in a deliberate order, because these are growth companies. So let's talk about growth first. And how people talk about something, the primacy reveals their preferences and what they think is important. So the meeting belongs to the guy who writes the check, right? It doesn't belong to this guy, the CEO. It belongs to the guy on the other side of the table, because he's going to write the check. You do what he needs to do to make the decision. So there's roadshow prep. The other thing about it is making sure that you're going and seeing the right people, which again is a function of experience. Like, I've been out of banking now for a little bit. Like, if I went back to banking and somebody said, who do I need to go see? I'd need to go talk to some folks, because I don't know who's doing deals. I'd be going through my Rolodex that's 5 years dated. So that's a function of experience. So who do you go see? How do you sell it? And then there's things around deal structure. So if it's an IPO, it's like, well, how big should the IPO be? Do you want to start by selling 10% of the company with the goal of trying to sell, by the time you've exercised the shoe, which is an extra 15%? Is that right? You got to remember that. And we're upsizing the deal with a goal of 15%. If somebody said we want to raise 15%, but we need at least 10, maybe you want to start at 10 and hope to upsize to 15, because sometimes if you go out too big or you get too aggressive on valuation, you end up with a cold deal. Whereas you want to build momentum, and again, I'm using that word again, which obviously I find dangerous, but you do want to have positive momentum, not crazy momentum, through the transaction. So I'd say having somebody who's done a lot of deals and has experience and wisdom around these things is important. I was an investment banker for more than a quarter century, and if we're doing an M&A transaction or we're going to go public, I would be really careful about the bankers that I hire and what they can bring to the table on making decisions around those things. So that's how I would approach that.
It's very obvious that you've achieved a lot throughout your career and moving forward. And you come across as very motivated, but also having real tangible evidence of success and of impact. But something I've noticed is your ability to both have that level of motivation whilst also being humble and grounded. Where does that stem from, and why do you think being humble and grounded is so useful, and how can other people implement that in their own lives?
Yeah, I'd say like a lot of my friends that I talk to, I'd say I've gotten more humble as I've gotten older. I knew a lot more with a lot greater conviction when I was a young man, that's for sure. I say that jokingly because I remember my dad telling me, I remember when I was your age and I knew everything. It was a great line. And you know, I'd say, and there were things in my 20s, early 20s, where I felt I had a great deal of conviction. And now, you know, at 56 with, you know, quite a few years in business, I get nervous around people that have really high conviction around stuff that seems to have a lot of variability. And so I try to poke around in that. Humility, yeah, thrust upon me. We maybe have talked about the successes, but there were certainly a lot of failures in there. And, you know, one of the great things about Silicon Valley, and one of the reasons I think it's so special, and going back to that comment earlier about it, you know, 1,000 years from now, people will study it, is because of the fault tolerance. And so I'd say as a young man, you know, starting out is, it's okay to make mistakes, make honest mistakes. Don't repeat them, learn from them. But, you know, there are other cultures which do not have this sort of fault tolerance, whereas like making a mistake is just, you know, that'll crush you. The CEO of Pinterest, I saw him at a conference, and he was Ben Silverman, I think, and he was fantastic. And I haven't talked to him or seen him in years, but at this conference, he was great. He got up and somebody asked a question like, well, why are you so successful? And he said, well, and I think he said, I started 6 companies and 5 of them didn't work. And I don't know why the 6 did. It was such a humble statement, but like, God bless the guy. And maybe it was 4 and 1 worked or 5 and 1 worked. I don't know, but that's not important. But the fact that he went and did it again, right? Just how awesome is that? And you see the folks that I've worked with, these entrepreneurs and VCs who just, you know, like Bessemer, I talked about them earlier. They have, it's a good read. It's their anti-portfolio, and they talk about all the deals they missed and why they missed. And it's a great exercise, kind of a post-mortem on like, where did we fail in this? But it's a great read. I haven't read it in a long time, but like it's, you know, it's important to learn from these things. So I'd say the humility, yeah, thrust upon me. And as I get older, I get more humble.
I've got 3 final questions. The first of which being, you can choose any scope of time that you'd like, whether, you know, 3 months, next year, 5 years, 10 years, etc. What's next for you?
What's next for me? Oh, you know, I'm pretty focused on my current job. I'm not really thinking about what comes after this. I would say I'd like to get on some boards of directors and do that. I would like to focus more on that. But I love my current job and want to see this thing through. And I don't know what precisely that means. But next for me, you know, my son graduated from college. My daughter is starting her 2nd year at Duke. So, you know, this is like it's a great stage of life. I have time and that I didn't have before for certain things. And it's, I don't know, it's great. It's a great stage of life. I'm really, really happy. I'm happy with, you know, where things are with work. So, yeah, what's next? Yeah, try to get old with a little bit of dignity. And, you know, maybe that's it.
My penultimate question, if I was to ask someone in 100 years' time, how would you want them to describe you and what would you want your legacy to be?
Okay, I like that question. I've got a really good friend, Will Quist. And so he's a member of the Olympic Club where I spent a lot of time, and his dad was too. And his dad passed away years ago. And Will has got a great relationship with my son. And so I went to his dad's funeral and I asked Will, I said, is it okay if I bring my son to this? And he said, yeah, please do. And he liked it. And we were driving down there to go to it. I told Wolfie, I said, pay attention because you're going to hear a lot about a really good man from some pretty impressive people. Pay attention to what they say. And it was, I was friends with his dad. I wasn't close to him, but it was a very moving service. And Will got up and spoke beautifully. My good friend did a great job, honored his dad. And I listened to people and I'm like, yeah, he did well. That he got these people to come and honor him, to say these things, and his kids love him, and the people who worked with him respected him. And yeah, that was pretty darn good. I had a similar experience at my dad's funeral, and not to make this sound really morbid, to think what do I want? But in 100 years, I mean, one of my good friends, when they say something about somebody, so tell me about so-and-so, he's a good guy. It's the simplest statement. It's really simple, but from my friends, when they say somebody's a good guy, I feel like I know the person. And, what this person was is like a husband, a father, how they did things at work. And one of the things I'm proud of with work is I've gotten a lot of things wrong. Certainly, we didn't talk about this, but certainly plenty of failure, got a lot of things wrong, said things that were not true. But I never lied. I was just wrong about stuff. They were honest mistakes. And I think that's a great way to go through stuff. And when you've got to play the long game where your reputation and your brand is so critically important, I love the fact, and I really believe this, that if you said, people say, well, if Ted Tobiason says something, you can take that, that is true. And I'm not just going to go pitch you stuff. And it kind of gets into the thing about creating the expectations that you could meet. And again, I've been wrong about stuff, for sure. But, I think I picked this up. I had a really great boss who was instrumental in my career, Phil Egan. And he was he's a truth seeker. And it's just a great quality to have. So I hope people say, I hope I earned that. And that's what people will think about me in, 100 years. Something like that. I hope they think about me at all in 100 years. 100 years is a long time.
And my final question, and I ask this to every guest on Personable, is what is one thing that you would want a listener to take away from this episode?
I'm going to go back to that one thing I said earlier. Grateful for what we have, just this time that we live in humanity. It's a remarkable time. It's a great time. There's some fragility to, the systems that enable this. And, we're the product of, the Enlightenment. We're a product of the industrial age or the age of technology. All these things have got us to where we are. And I think this is a glorious time. And I know that there's the, what's it called? I think the dissatisfaction gene, where, people are this is terrible, this is terrible. And there's some constructive element to that, where it's we're just not satisfied with what we have. We need to go make these things better, make people freer, make people wealthier, make people healthier, all these things. All for it. Don't be satisfied. Let's keep pushing the ball forward. But I worry sometimes that we maybe take that too far, and that puts at risk the systems that we've had that made this, the freest, most prosperous, healthiest time in the history of humanity. I feel like, you and me, we hit the lottery to be born, where we are and when. And so, if anything, I'd say if we were in 1,000 years, we'll study Silicon Valley and everything. But I think just this epoch in time is phenomenal. Grateful for it.
Thank you very much, Ted. It's been a pleasure and an honor to have you on the Personable podcast. It's been fascinating to learn about how your incredible journey. And there was a strong emphasis on the success. I mean, it doesn't say on your LinkedIn profile the failures, so I wasn't going to bring that up on this podcast. I love your ability to innovate and adapt when things aren't going well, and also to add your own unique spin on what it means to be a CFO, whilst having perspective and the ability to be humble, whilst also being able to adapt and grow. I didn't mention this, but you were also the first investment banker on Twitter, which is exciting. Perhaps room for further discussion or another podcast. But overall, thank you very much. I'm sure the listeners of this episode will have taken a lot away, and I wish you the best with everything moving forward.
Harvey, thank you very much. This was great.